Well, if you haven't already structured your portfolio to protect against a little bit of a correction that we might see, it is probably time to get on that. This morning, the Dow Jones kicked off September. Great start to the month, a steep drop, around 650 points at the time I'm filming this video, 1.6%. There are more fears of an economic slowdown and re-emerging, and we're seeing that in the markets. S&P 500, Nasdaq, also they took hits. S&P was down about 2% this morning. Tech stocks taking the brunt of the sell-off this morning. The TSX here, it was down, not quite as badly. It was down about 1.3%. Now, Nvidia, this is obviously the tech giant, a favorite amongst investors. It led the decline. It was down more than 9% this morning. So it's a pretty auspicious start to the month of September here. Now, this market, you could say it was already a bit on edge. We saw disappointing manufacturing data released this morning. Both the S&P Global and the Institute for Supply Management, they reported weaker than expected manufacturing activity. The manufacturing PMI was down at 47.2 this morning. That has sort of fueled some additional worries about the health of the U.S. economy in general. Now, Larry Tenterelli, he's the chief technical strategist at Blue Chip Trend Report. He says the market right now seems to be very jumpy to any data that comes in. We've become a very data-dependent market. When we look ahead a little bit here with the first major economic report of the month, that is the August jobs report, which comes out this Friday. I would think that investors are probably bracing for some more volatility there. If that isn't enough, the stock market is also dealing with this historical trend that we see in September being typically a pretty rough month. If we look back over history, the S&P 500 has lost more than 2% on average over the month of September, over the last decade or so. August was a pretty good month for the major indices, but as we see this rough start here in September, it's just a reminder that the road ahead could be bumpy, as it often is this time of year. What is next for mortgage rates here in Canada? Well, the Bank of Canada, it looks like it's pretty certain it will be cutting interest rates again tomorrow for the third time in a row. Everyone's pretty much expecting a quarter point drop there. That'll bring the benchmark rate down to 4.25%. We have seen over the last little while inflation getting closer to the bank's 2% target. We've seen unemployment creeping up. So this move really seems to make a lot of sense. But what's really interesting here is how fast and how much the Bank of Canada will cut rates as we move forward over the next number of months. Now, Benjamin writes this. He's from the Bank of Montreal, and he says, clearly, their rates should be lower than where they are now, and the bank's moving slowly and surely in that direction. Now, Governor Tiff Macklem, he has been talking a lot in his latest speeches about the downside risks, and that means basically that they're more worried that the economy is slowing down too much. And that's probably plays into why a lot of the analysts are believing that the Bank of Canada will certainly continue to cut rates in the coming months. Some, in fact, are predicting we could see rates drop all the way down to 3% by the middle of next year, with several more quarter point cuts coming along the way. When you look at Canada's economic picture lately, it has been pretty sluggish out there. We have seen people and businesses, both of these categories, pulling back on spending, obviously because of the higher borrowing costs. Unemployment, we've seen that rise to 6.4%. That's a big jump from where it was just a couple of years ago. Now, on a positive note, the slowdown has helped bring inflation down to 2.5%. That's, again, the lowest number that we've seen now in over 3 years. Now, according to Royce Mendez at Desjardins Securities, he says the focus now is on the labor market and the pace of economic growth. So when we look ahead here, definitely the lower rates could give the economy a boost by next year. There is still one big overhanging concern, though, and that is the mortgage renewals that are coming up. And there are a ton of homeowners who will be renewing their mortgages at a higher rate. Even though we've seen rates come down compared to when they booked those rates, say 5 years ago, even with these cuts, we're going to see higher rates come up there. Now, I am going to finish this segment here with another Royce Mendez quote, pretty much sum things up. He says, it's a big reason as to why the Bank of Canada needed to begin this rate cutting cycle early and needs to get rates down before the mortgage renewal wall hits in April 2025, 5 years after rates basically fell to zero. Looking for a smart way to invest your money? Well, BMO ETFs and mutual funds, they offer you a range of solutions to suit your needs and your goals. So whether you want to diversify your portfolio or access innovative strategies, BMO GAM has you covered. You can choose from a variety of ETFs and mutual funds that span across markets, asset classes, and geographies. You can also benefit from BMO GAM's experience and, of course, their insights on the latest trends and opportunities in the financial world. BMO ETFs and mutual funds, it is the right fit for your portfolio. Visit bmogam.com today. That's BMOGAM.com today to find out more. Now, If you are one of those people who is just tired of real estate being out of reach, I'd like to introduce you to Addy. At Addy, they believe that everyone should have a shot at property ownership, no matter your income, your age, your background. With their platform, you can invest any amount in institutional grade commercial real estate, and that makes property ownership a reality for all. Visit Addy today. Take your first steps toward owning a piece of the future. You can sign up at addyinvest.ca, and if you use the referral code BEAVIS100, you get your free Addy One membership. Well, you can't help but wonder whether there maybe is a new trade war brewing between China and Canada. As I reported on this channel just last week, Canada announced new tariffs on Chinese electric vehicles and steel, and now China has launched an anti-dumping investigation into Canadian canola imports. No doubt this will escalate trade tensions between the two countries. Also of note, this move comes 2 years after China had lifted the previous ban on Canadian canola, so this is a clear retaliation against Ottawa's recent actions. China's Commerce Ministry claims that Canadian canola exports have surged by 170% over the past year, while prices have dropped significantly, and that suggests that there is a potential dumping behavior. The ministry said, affected by unfair competition from the Canadian side, China's domestic rapeseed-related industry continues to lose money. Now, Canada's justification for the 100% tariffs on Chinese EVs, that echoed the same sentiment. The officials argued that the measures were necessary to protect Canada's emerging EV market from being undercut by cheaper imports. The tariffs also followed a similar move by the U.S., so they've aligned Canada and the U.S. in its stance that they share against these Chinese trade practices. There have been some signs recently that trade relationships between Canada and China had been improving, but obviously with this latest exchange over EV tariffs and now the canola issue, that threatens to wipe out any progress that had been made there. Now, Chinese embassy in Canada, they sharply criticized the EV tariffs as trade protectionism and a politically motivated decision that undermines Canada's reputation as a defender of free trade. We already are living in a pretty charged political environment here. People are now starting to ask whether big corporations in Canada are getting a free pass on taxes. Last year, the federal government approved a massive spike in corporate write-offs, with 11 companies accounting for $1.2 billion out of the $4.9 billion total write-offs. These 11 cases alone made up nearly a quarter of all the write-offs in Canada. And this increase has raised a few eyebrows, especially with the fact that the Canada Revenue Agency isn't revealing who these companies are, and they cite privacy reasons for that. Now, Conservative MP Adam Chambers, he's calling for more transparency, and he's arguing that Canadians deserve to know which companies are benefiting from these large write-offs. And he asked, we're talking about corporations that are getting write-offs to the tune of hundreds of millions of dollars. There should be more transparency about how that is working. It raises questions about who they are. Or do they have connections? Are they well represented by lobbyists? The CRA explains that write-offs can happen for a bunch of different reasons, and they cite bankruptcy, they cite financial hardship, and they often only come at the end of a process, like sort of an exhaustive process of all available collection methods, and it comes down to this. Now, last year's $4.9 billion in write-offs, that was the highest now in 9 years. Just 5 taxpayers, which could be corporations or it could be individuals, accounting for more than $1 billion. The CRA, again, citing legal restrictions, isn't giving us any more information than that. Now, MP Chambers, he's asking why the agency is approving such large write-offs while still aggressively pursuing small businesses and individuals for smaller debts, for example, ineligible pandemic benefits. Now, he says the CRA's increased staffing and budget were supposed to enhance its ability to target tax evasion, but the nearly $5 billion in write-offs is drawing attention here for all the wrong reasons. The CRA defends its actions. They say that the amount of uncollectible tax fluctuates from year to year. CRA spokesperson Kim Tifo, she says, the CRA employs a rigorous process to ensure all collection methods are examined. As there are costs in carrying out collection activities, in certain circumstances, the debts should be deemed uncollectible in order to administer public funds properly. Deeming a debt uncollectible is a normal part of established business accounting procedures. Unpaid tax debts represent a small portion of the total receivables, and the vast majority of accounts receivable will be collected over time. Well, that's a wrap for today's show. Tomorrow, I will be putting out a full recap of the latest third quarter earnings from all the big Canadian banks. And then on Thursday, back with the next episode of this series. I will thank you, as always, for watching the video. We'll see you next time.